The following segment is sponsored by Prime Capital Investment Advisors. Jason Noble is joining us today to talk about the 4 non-negotiable pillars of retirement planning. Oh, 4 of them. Good to have you on the show with us, by the way. Excellent. And by the way, you need to give Jason a call his office, go down and see them. Beautiful office, beautiful view, have a cup of coffee, sit down and talk about your investments. It's very easygoing. It's very relaxed and you'll learn a lot. I learn a lot every time that I'm sitting down with. Let's talk about the fees that you are currently paying on your investment.
Having that being a pillar is such an important thing because you can have what's called fee drag if you have too much in fees. It's not just like what is the advisor charging, but what about the investments that you're going into? What are the fees inside of there? They're also known as what's called expense ratios, but those are hidden costs. What about any administrative costs that are associated within the strategy or the investments as well? All these things come into play.
Sure.
And I understand you're going to want to pay for proper advice and guidance.
Sure.
But is the advisor looking at cost-effective investments and strategies to put more money in your pocket and less in theirs?
Yeah.
We call that a fiduciary in the industry, and that's the responsibility that we hold to our clients.
If I were your client, when I'm making money, you're making money. When I'm not making money, you're not making money.
That's right.
That's pretty much what a fiduciary is, right?
Well, I get a pay raise if I do a good job and grow your accounts.
All day?
I get a pay cut if the portfolio goes down.
Yeah.
Now, you know, the market went down 22% and back in 2022. It's nice to have those kind of memories, right? Going down that memory lane, not the best, a little rocky. But like my clients that went down like 5%, they didn't go down anywhere near what the market did, but I still got paid less. But that's, you know, a true fiduciary is not going to look at what they get paid. They're going to look at the services and the experiences that they provide their clients.
Yeah, I love that because whenever I'm doing really well in the market, you're doing really well as my advisor. If I'm not doing good, I don't want to be paying out a bunch of money still to my advisor. It doesn't make sense because you're evidently not doing the research and then advising me the right way, and I'm not making money. So the fiduciary, to me, is just always the way to go.
Yeah, and a fiduciary standard is the higher standard of the 2 standards that the industry is held to. The other standard is called suitability standard. At the time of recommendation, was the investment suitable? And right now, as we're having this conversation, there's a lawsuit that's going on where this firm said that they were held to the fiduciary responsibility, but they lost the client $50 million. So understanding the true essence of fiduciary is so important, and this is why I'm here today to talk about this, is I'm held to the fiduciary standard under the 1940 Act, but I'm also a fiduciary because I'm a CFP and an RICP, Retirement Income Certified Professional, and a Certified Financial Professional. Those 2 designations have fiduciary responsibility baked into my continuing education and to the bylaws of Code of Ethics.
Tell me about the difference between risk tolerance versus risk capacity.
Risk tolerance, you know, Tom, I think a couple months ago we had the conversation about how you feel about risk. Risk capacity is looking at how much risk can you take within your investment strategy and your own personalized retirement plan. Of the 2, risk tolerance is easier to get because you fill out a questionnaire. Risk capacity is determined by the complexity of the financial plan, and then that has to be articulated back to you to make sure it's aligned.
Let's talk about taxes. Are we paying too much taxes sometimes, and can you help an individual out with that?
I believe most people are paying too much in taxes, and then how do you come up with a proper tax approach and strategy where you pay your fair share, right? But you're not paying a penny more than what you absolutely need to.
Whatever the definition of fair share is.
Making sure you don't get in trouble.
Yeah, exactly, exactly.
Right, but then I will go into this, is in 2026, the Tax Cut and Job Act expires. So it's really at the end of 25, so into 2026. Taxes are going to go back to the 2017 limits, which are higher than they are at the time of this conversation. And if you're not preparing for that, that could be a big issue as you go into your retirement and you have that tax drag on your retirement. I just don't see giving 20% of your money to Uncle Sam while you work so hard for it is a prudent approach. It's about how do you go about making these decisions and using these pillars all in conjunction.
Yeah, which comes into your second grouping of credentials as a retirement investment strategist, coach, advisor, which helps out a lot, because you can help people throughout their career investing, but once you get to that point where you're going to retire, are you retiring correctly? Are you going to have enough money for the long run, however long that run is?
Well, yeah, in the state of South Carolina, of all the CFPs that are out there, Certified Financial Planners, only 2.1 operate in the state of South Carolina.
Oh, wow.
So not only am I one of the 2.1% that operate, but I'm also a retirement income certified professional. And the fourth pillar is making sure you have income streams that last you throughout your retirement.
Yeah.
If this is something that you're interested in talking about, you know the number,
Give
843-743-2926.
That's the man, Jason Noble. Always a pleasure with Prime Capital Investment Advisors. We've got more Lowcountry Live right after this. Stay with us.